Well, this is the last Valuation Master Class Show for the year. And yesterday I had some technical difficulty. People couldn't hear me. So if you can hear me, can you leave a message that you hear me so I can see that? Just leave a message in the chat. If you can't hear me, then you won't know what I'm saying. Today, I'm going to be talking about interest rates. And I think it's probably one of the most important things that we got to pay attention to right now in the world of valuation. And what I'm going to do is I'm going to show you interest rates across the world, what to expect with interest rates in 2026, and why it matters. If you want this presentation and my interest rate book, just type in IRB in an email to me at Andrew Stotts, and I'll send this to you. So before we get into it, I just wanted to talk briefly about interest rates because it's such a fascinating topic. Interest rates are basically in everything. Everything has an interest rate embedded in it. Whenever we see return on equity or any other type of measure, there's an embedded inflation premium in it and other items. So interest rates are critical. And when interest rates fall significantly, we tend to see equity markets and stocks do really well. And when interest rates rise, we tend to see equity markets suffer. And within companies, for instance, companies that have a lot of debt, those companies basically are going to suffer a lot when interest rates go up. And every politician wants interest rates to go down to zero because when they go down to zero, then it can fire up the economy. Of course, it'll set off inflation potentially, but that's not something that a politician worries about because they're only caring about what they can get right now. Now, I'm kind of an obsessed guy when it comes to numbers. So I have some huge files that I've maintained over many, many years. And one of them is my interest rate file that I've maintained for a long time. And basically, I look at the interest rates of every company in the world, every country in the world that has consistent data, from Russia to the US, as an example, emerging markets, and everywhere. And then I use that to come up with a chart book. And that's this chart book, which I'm going to walk you through some parts of it. I'm not going to go through all of it. But if you want this chart book and you want me to update it every month so I understand what's happening with interest rates, then just send IRB in an email to me and I'll send it to you. So before we talk about that, let's talk about Fed funds rate. Right now, consensus is expecting Fed funds rate to drift a little bit lower from 3.7 today to about 3.2 by October. I think they're wrong in that. It's going to come down by about 1% by the end of June, and then by another 1% by October. This is a pretty crazy forecast, but I'm basing it on the idea that I think Trump is going to do everything he can to bring down interest rates in the hope that it fires up the economy and that helps him survive the midterm election in November of 2026. Now, this is the global interest rate chart book, and this is up till the end of November. You have to stop somewhere, and that's the data that we have the best information on right now. And so let's just look at it. The first thing is global markets. If we look at all markets in the world, we're seeing global easing in interest rates, but higher emerging market yields continue to show high inflation and risk. So let's look at that in the first way, which is what I would call the interest rate level. And here you can see world 3 months rates at about 4.3 and 10 years at about 5, but it's much higher in emerging markets. So let's look at that breakdown. Here we can see the three-month yield for emerging markets is 4.3, and in developed markets it's 2.9, and emerging markets it's 6.3. So we can see a 3.3 percentage point premium that's being demanded if emerging market countries are borrowing money. Now, keep in mind, this whole thing is based upon government rates, not bank rates or lending rates that we see or deposit rates in the economy. This is central bank rates. So when central banks want to borrow, this is what they borrow at. Now, what's great about this rate is that it's risk-free technically. Now, if you are a person from, let's say, Thailand, where I am, and you buy an Italian, let's say an Italian bond, or even better, let's say you buy a Canadian bond. And so now you have to buy the Canadian dollar and then the bond. So when we say that a government bond is risk-free, basically what we're saying is the actual bond aspect of it's risk-free, but the currency aspect of it's not. So when you're looking at your own home bonds, then it's risk-free. But as far as credit risk and other types of risks, it doesn't exist in government bonds, and therefore we like to look at government bonds. So that's 3-month yield. Next, I'm going to look at 1-year yield. And 1-year yield's about 4.3, developed markets about 2.9, and emerging markets about 6.5. So not much different from 3-month. And we see an even wider 3.6 percentage point gap between emerging and developed. And then if we look at the next area, which is 10-year yields, we can see that developed markets 3.5, emerging markets is 7.2. And there's about a 3.6% percentage points premium that emerging markets are demanding, basically. Now, what does that mean? That premium basically means, again, that if an emerging market wanted to borrow money, it's going to have to borrow at a much higher rate. All right, let's continue and go to the next section. And the next section has to do with year-on-year changes. So we just looked at the interest rate level there. Here we're going to see that developed market short-term yields fell sharply and emerging markets stayed high across the curve. So let's look at this in a little bit more detail. We can see that 3-month developed market yield had a large 0.7 percentage point year-on-year fall to 2.9, and emerging markets had a smaller relative 0.4 percentage point fall to 6.3. So the rates are really coming down over the past year in the developed markets, much more than we can see in the developed markets or in the emerging markets. And the point is that emerging market rates are high and they're not coming down. The developed markets like US and Europe, as an example, have the ability to keep bringing rates down without a major impact on their currency. And that's because people trade and use their currencies for exchange. Let's now go from what we can see here is 3-month yields. Let's look at 1 year and look at the change, and we can see 1 year developed market yield had a large 0.5 percentage point year-on-year fall to 2.9, and emerging markets again had a relatively smaller, now this is 0.6 percentage points is a little bit larger in number terms, but given that the emerging markets are much higher, then we can see it's actually a smaller relative return. So now let's look at the 10-year developed market yield had only a very, very tiny actual rise, and emerging markets had a small fall. Now, this is interesting because, wait a minute, aren't interest rates coming down in developed markets? Well, in fact, in the 10-year yield, they're actually rising slightly. So this brings us to the discussion to understand, first of all, I believe if you're a free market person like me, you would never accept the government setting the price of an iPhone. But why is it that we accept the government setting of the price of money, the interest rate? Everybody's so into that they've seen it for so long, they think that that's the best way to go. I don't believe that the Fed is they're politically controlled. It's not market controlled. And basically, also what you're about to see, I'm going to talk to you about, is the 10-year yield. We saw the 10-year yield in the developed markets rising when short-term yields were coming down. Well, this shows the power of the Fed in this case. The Fed in America, as well as the central banks throughout the world, they want to be able to control interest rates. But the truth is they can't. The markets are too huge. It would just be crazy. And so the result of that is that they try to control the short end of the curve. 3-month money, 1-month money, short-term money. That's where they have a potential for more control. Generally, what they hope is that they're going to bring down short-term rates and long-term rates are going to follow because they're set by the market. But that's actually not what happened here. And it's not always what happens, because sometimes when people see short-term rates coming down, they think, ooh, that's going to fire up inflation. And long-term rates is really a culmination of two components: the inflation premium and compensation for growth in the economy. Let's say long-term rates are 3%. Maybe it's 1.5% that's for inflation, and let's say it's 1.5% for expected growth in the economy. But if the Fed lowers rates really low, and you think that's going to fire up inflation, for a 10-year bond, you may decide, I want more compensation than 1.5. I want 1.7. And therefore, that 10-year rate goes from 3% to 3.2. And so that's the concept of what's happening, where we can see that short-term rates go down, but long-term yields didn't rise. Now, also, when I'm talking about rates and yields, I'm talking about the same thing. We tend to say a government bond has a yield of a certain amount, but also we say that the government bond is setting the rate. So now let's look at the rate progression. And what we're going to see is that developed market easings has been happening while emerging markets have stayed elevated. So let's look at this in a little bit more detail. This is from November of 2024 to November this year, last month. We can see short-term yields fell globally, and basically there's still a 2 percentage point premium above the world average for emerging. And there really hasn't been any major change in that on a 1-year basis. Not a lot there, but what's interesting is on a 10-year basis, we can see that the rate has been somewhat flat. And in fact, there was an increase in December last year that you can see is partially driving the increase that we saw globally. But the point here is, even though interest rates are low and the Fed's trying to bring them down, they're not able to control the 10-year government bond yield. And that's why it's been flat. Let's look at the last thing in this section, which is emerging markets higher and steeper and developed markets flatter with easing. This is the yield curve. Now, this is the way I like to look at the yield curve. On the left-hand side, you'll see November of 2024, the 3-month rate was 4.9 and the 10-year rate was 5. If we say 5 minus 4.9 equals 0.2. Now, there is any slight differences is just coming from rounding. Now, if we want to look at the past month, that's October of 2025, the short-term rate, 3-month rate was 4.3 and 5% for the 10-year. That's a gap of 0.7. And when this gap is positive, it means a positive yield curve. And we can see on a month-on-month basis, there really wasn't any change. If we look at the developed market yield curve, it's gotten definitely steeper than a year ago, but it's relatively flat. It was negative or inverting yield curve in 2024, and now we're at a normal situation where short-term rates are lower than long-term rates, as we can see there. And November also showed a steepening in emerging markets yield curve, and it's gone from 0.7 previously, then to 0.8 and to 0.9. Now, you may ask yourself, well, why is it that emerging markets were never negative? Well, the reason why emerging markets never have a negative yield curve is because they don't have the ability to bring short-term rates down to near zero like the developed market countries do. Those countries, the developed market countries, they have this fantastic ability to lower interest rates very, very low without impacting the currency. Now, if a country like Thailand, as an example, did a lowering of the baht currency rate, then you potentially have a risk that foreign investors will sell baht because they're not earning much on it, and therefore it'll push down the currency. The US and developed markets don't have those kinds of pressures. So let's continue on and look at the key points. Short-term rates fell to about 4% globally, while long-term rates held near 5%. And developed market short-term rates dropped more, and they're now around 3%. And emerging market rates stayed higher. They're near 6 to 7%. And the premium of emerging markets and developed markets stayed wide at roughly 3 to 4 percentage points across maturities. And yield curves were mostly flat, with emerging markets showing a small rise at longer terms. Finally, global easing but elevated emerging market yields reflect ongoing inflation and risks. So basically, the inflation is the concern and currencies are a concern. That gives you a picture of interest rates globally. What I want to do next is go into it in the next step down. Let's look at the next step down for the interest rates. And this is developed markets. And what we can see is developed market rates ease from peaks and curves normalize, though developed market Asia edges slightly higher. Now, what country is in developed market Asia? Well, Singapore, as an example, and Japan, Japan being a huge market. So let's look at what's happening. We have at the interest rate level, we have high developed market America's rates and emerging market Europe lower, and developed market Pacific much lower. So let's look at this in a little bit more detail. So I'm going to break down the left-hand side, which is developed markets, which we can break into Americas, Europe, and Pacific. And what we can see from this is that developed markets has a 3-month yield of 2.9, and the big difference is Asia Pacific at 1.5. Again, that's mainly driven by Japan. On a 1-year yield basis, we have the similar gap, and then on a 10-year basis, you can see that the gap is more narrow. The Pacific is not down in single one digits. They're basically at 2.6%. So let's look at what's been happening. We can see as we look at changes is that short-term rates in developed market Europe are rising, and long-term rates rising in developed market Americas. So here we can see that developed market 3-month rates fell year on year, and that was led by Americas and Europe, while Pacific saw a smaller decline down to 1.5. Again, this is year on year. Recently, we've seen Japanese rates in particular rising, but this is year on year. And we can see developed market 1-year rates fell year on year, and that was led by the same. And finally, let's look at developed market 10-year rates. And basically, they diverged in Americas, but they're rising in Europe and in Pacific. So we saw interest rates in developed market Pacific, as an example, led by Japan, falling, and now we can see on the long-term 10-year level, they're rising. Now, the next thing is the rate progression, and rates hardly moved month on month across all developed market regions. So we'll go through this pretty quickly. We'll see that the rates were pretty flat. 3-month rates, 1-year rates were flat, and we can see that 10-year rates were flat. So that gives us a picture of what's happening in the developed markets. Next, let's look at rising long-term rates in developed market Americas and Europe, flattening yield curve, and its normal yield curve in developed market Pacific. Here we can see that developed market Americas inversion basically has reversed from 0.3, meaning long-term rates are lower than short-term rates. Up until recently, they've switched that and they've gone to normal positioning. If we look at Europe, we can see there was a slight inversion, but that's been reversed. And if we look at developed market Pacific, it's always been a normal curve where short-term is less than long-term, but that's growing quite a bit. And then what's the point? Well, short-term rates are highest in Americas and lowest in Pacific, showing policy divergence. And overall rates decline year on year, led by short-term drops in Americas and Europe. And medium and long-term rates stabilize with mild rises in Europe and Pacific. The curves, the yield curves, are normalizing as long-term rates and short-term rates are easing across the region. There's so much in this interest rate chart book that I have that I'm not going to go through it all, but it gives you some picture of a few things that we've talked about. The first one is my expectation of where rates are going. The second thing, and I think that Fed is going to cut the rates massively. The second thing that we talked about was understanding the connection between valuation of a company or a market based upon rates. If rates go lower and lower, then we tend to get a higher value. So this is why it's important to pay attention when we hear Trump trying to get interest rates down. And then we've gone through the different areas. Now, again, if you want to get the chart book, just send me an email at me@andrewstotts and type in IRB, and I'm going to put you on the list so that you can get access to that. That is something that is very valuable, and I spent a huge amount of time working on it. Remember that the Valuation Master Class Show is sponsored by Valuation Master Class Bootcamp. The next bootcamp starts on February 16th. So if you want to join, just send VMBC to me@andrewstotts, and I'll give you an extra $100 off Valuation Masterclass Bootcamp. I want to thank you for joining today, and I also want to wish you a happy new year. It was a great year for us, and I hope that things go well for you in 2020.